Welcome back to SWA's Take 5 Insights. I'm Tendai, this is Jason, and can you believe we already made it midway through the year? There has been a ton of things going on and a lot of market gyrations. Jason, tell us a little bit about how we've gotten here and what's been driving the market thus far.
Tendai, it's very simple this year. Market movements have been driven mainly by tariff headlines and U.S. trade policy and the uncertainty around that. We did have quite a bit of a market sell-off early in the year. We're up 28% since the low in April, back to new all-time highs. And so, that is a lot of what drove market returns. I will say internationally, it's benefited investors that have been diversified internationally. This has mainly been driven by the dollar, falling dollar, 6 straight months to start the year. Fixed income bond returns have been pretty solid, a little bit volatile, but that's helped out a little bit this year. Earnings have been fine so far this year. Economically, all of the soft data or confidence surveys, consumer confidence, et cetera, has been pretty soft, but the hard data has been pretty good. So I think that's where you're seeing markets be very volatile, but now still again towards at all-time highs.
That's great, Jason. So, for the everyday person, what does this mean from an economic perspective?
Yeah, I think the economy is pretty good. The job market is still pretty solid. It's slowing a little bit, but we're still job openings are still where they were right around pre-COVID. So, and they were pretty healthy then. There's a little bit of evidence of a slowing economy, but the consumer is still spending. The consumer is 70% of our economy. And if you look at TSA screenings, flights, if you look at, I think restaurants bookings are up 13% year to date. Hotels are above trend. The consumer is still spending healthily. The other thing is our economy is 70% services. So, services don't tend to have quite as big an impact from tariffs. So, predictions of recessions have come down since early April. I think we have a better idea where the tariffs are going to land, maybe about between 15 and 20%, maybe closer to 15% globally, which is definitely higher than we were, but I think it's finally a place where companies and people can adjust and start to go forward. There's plenty of uncertainty that remains. There are going to be court case challenges there are to the tariffs, and we still don't have specifics around, tariffs around specific sectors, pharmaceuticals, etc. We haven't felt probably the full brunt of negative effects of tariffs yet. Could see a rise in inflation in the short term, second half of the year, or even into 2026. It should be kind of a one-time adjustment. And we could see a little bit of a hit to earnings in the short term.
Gotcha. So a lot of positive notes there. And earlier in the year, we did send out a note to our clients regarding portfolio adjustments we've made given the environmental factors we just talked about. Can you kind of highlight that for us again?
Yeah. So this year we have adjusted overall allocation for our clients. We've trimmed equities, taken some profits. We've also trimmed alternatives to add to bonds and fixed income, just to lower the volatility, potential volatility for clients. We've also leaned more heavily into AI-related equity or stock exposure. We think that's a continuing explosive growth area. And then we also added to a little bit of international bond exposure, again, to diversify within our bond allocation because of the uncertainty that lies ahead.
Gotcha. And so what message would we want to send clients away with today, and what are some positive things that folks can look forward to?
Yeah, first of all, innovation and productivity is exploding in the U.S. right now. Over the past 5 years, productivity has increased by about 9%. And that in the next closest country is not even half that. This creates a lot of opportunities. You think the need to build out data centers, the need to build out energy infrastructure. You think of the medical breakthroughs that are potentially going to happen, and all the innovation with automation, et cetera. So, this creates a lot of opportunity, I think, going forward. businesses are healthy, have great balance sheets. Average consumer is very healthy. I think private wealth is triple the size it was 10 years ago. These are all very healthy and positive things to look at. Now, having said all this, Tendai, we can't predict the ups and downs of the market, especially in the short term. We could see, like we said earlier, some hiccups from tariffs, maybe some one-time upward inflation adjustments, maybe a short-term hit to earnings per share for the stock market. So don't let any of that potentially knock you off your long-term investment strategy, your goals, and your objective. Stick to the plan and look at the positives that we just mentioned that are definitely going on in today's investment and economic world.
Wow. So, Jason, just as we started, we said there has been a lot going on through the first 6-7 months of this year. And so you highlighted a lot of great points. So really appreciate you simplifying a very complex environment that we're operating in. On that note, again, I'm Tendai, you're Jason. If you have any questions whatsoever, please reach out to ourselves or anyone else here at the Salem Wealth Advisors team. And until then, we'll talk to you next time.